Have you ever wondered what truly powers our global economy? It's not just money in your wallet or the cash in a bank vault. There's a far more pervasive, yet often misunderstood, force at play: credit. This invisible engine dictates everything from your mortgage rates to the stability of entire nations. Understanding credit isn't just for economists. It's essential for anyone navigating today's complex financial landscape, from students planning their future to investors making critical decisions. Most people perceive credit as a straightforward concept: a loan, a credit card, or borrowing from a bank. This narrow view misses the profound, systemic role credit plays. It's not merely a transaction, it's the very lifeblood of economic activity, silently determining growth trajectories, business viability, and financial stability. When credit flows freely, economies hum with activity, fostering innovation and prosperity. When it tightens, uncertainty mounts, and even robust systems can falter. This pervasive influence means that credit affects everyone, every day, often without conscious recognition. It shapes the opportunities available to individuals, the strategic choices made by businesses, and the policy decisions enacted by governments. By the end of this video, you will possess a comprehensive understanding of credit's true nature, its creation, its movement through the economy, and why its fluctuations impact us all. This isn't about predicting the future or instilling fear. It's about empowering you with clarity, transforming complex financial shifts into understandable dynamics. Credit is fundamentally distinct from money. Money represents existing purchasing power. Credit, however, is the permission to utilize purchasing power that does not yet exist. When credit is extended, new economic capacity is brought into being. This newly created capacity fuels the economy, acting as a critical bridge between current resources and future potential. This concept is vital for personal finance, business strategy, and understanding the broader economy. For individuals, credit enables significant life purchases like homes or education, leveraging future earnings for present needs. For businesses, it provides the capital to invest in expansion, research, and development, driving innovation and job creation. Governments rely on credit to fund public services, infrastructure projects, and manage fiscal policy. Without this mechanism, economic activity would be severely constrained, limiting growth and societal advancement. Credit, therefore, is not just a financial instrument. It's a fundamental enabler of economic progress, shaping behavior and outcomes more profoundly than almost any other factor. A common misconception is that banks lend out money deposited by others. In reality, the creation of credit is a more dynamic process. When a bank extends a loan, it doesn't simply transfer existing funds. It creates a new deposit in the borrower's account. This act simultaneously creates a new asset, the loan, and a new liability, the deposit, on the bank's balance sheet, effectively bringing new money into existence. This process, often referred to as fractional reserve banking, allows a small amount of reserves to support a much larger volume of credit. This mechanism has profound implications. When credit expands, the money supply increases, leading to greater spending, heightened economic activity, and accelerated growth. Businesses find it easier to secure funding for projects. Consumers have more access to financing, and investment flows freely. Conversely, when credit contracts, the money supply shrinks. Spending slows, economic activity declines, and financial risks become more apparent. This expansion and contraction cycle operates continuously, often beneath the surface, yet its effects ripple through every sector of the economy, influencing everything from inflation rates to employment levels. An economy's growth isn't solely a function of hard work. It's significantly driven by the efficient coordination that credit enables. Credit acts as the lubricant that allows the complex machinery of commerce to operate smoothly and expand. It facilitates the allocation of capital to its most productive uses, transforming ideas into tangible assets and services. Businesses leverage credit for strategic investments, hiring skilled employees, acquiring cutting-edge equipment, and expanding into new markets. This access to capital allows them to innovate, increase productivity, and remain competitive. Households utilize credit to make substantial, long-term investments such as purchasing homes, financing education, or smoothing consumption over time. thereby improving their quality of life and building wealth. Governments, in turn, depend on credit to fund essential public services, build critical infrastructure like roads and hospitals, and implement counter-cyclical policies to stabilize the economy during downturns. Without this vital financial mechanism, economic activity would dramatically slow, hindering progress and limiting opportunities for all stakeholders. Periods of credit expansion often feel like economic golden ages. When credit is readily available and inexpensive, a positive feedback loop emerges. Projects that were once deemed too risky or expensive suddenly become viable, leading to a surge in investment and innovation. New businesses emerge, existing ones expand, and job creation accelerates. This environment fosters a sense of confidence and optimism, making growth feel natural and sustainable. Asset prices, from real estate to stocks, tend to rise, creating a wealth effect that further encourages spending and investment. However, this seemingly benign expansion carries an inherent trade-off. Credit expansion essentially pulls future demand into the present. It allows individuals and businesses to consume and invest today based on anticipated future income. While this can stimulate growth, it also means that a portion of future economic activity has been borrowed. This dynamic creates an eventual need for adjustment, as the capacity for future borrowing diminishes or the ability to service existing debt becomes strained. Consequently, periods of easy credit, while initially exhilarating, inevitably lead to a point where the pace must slow or even reverse, setting the stage for the next phase of the credit cycle. When credit conditions tighten, the economic landscape shifts dramatically, often leading to discomfort and uncertainty. Lending standards become more stringent, risk tolerance among lenders diminishes, and access to capital becomes more challenging and expensive. This doesn't necessarily signify a broken economy. Rather, it indicates a necessary adjustment within the financial system. The contraction phase serves to reveal underlying vulnerabilities that were masked during the expansion. During this period, projects that were overly reliant on cheap and abundant financing may falter. Businesses with fragile balance sheets, accumulated during periods of easy credit, face increased pressure. Optimistic assumptions about future growth and profitability are reevaluated, often leading to write-downs and restructuring. For individuals, access to mortgages or personal loans becomes harder, impacting consumption and investment plans. While painful, this deleveraging process is a historical norm, essential for purging excesses and reestablishing a more sustainable foundation for future growth. Understanding this adjustment phase is crucial for investors to identify undervalued assets and for business owners to adapt their strategies. Today's global financial system is characterized by an unprecedented reliance on credit, making it far more sensitive to changes in credit conditions than in previous eras. Several factors contribute to this heightened sensitivity. We've experienced longer credit cycles, driven in part by accommodative monetary policies and financial innovation. Balance sheets of both financial institutions and corporations have grown significantly, meaning larger volumes of debt are outstanding. Furthermore, persistently low borrowing costs for extended periods have encouraged greater leverage across the economy. These structural shifts mean that when credit conditions change, whether due to central bank policy, market sentiment, or regulatory shifts, the effects are felt more widely and rapidly. A slight increase in interest rates or a minor tightening of lending standards can have amplified ripple effects across interconnected markets. This doesn't necessarily portend collapse, but it does underscore the system's inherent sensitivity. For policymakers, this means navigating economic cycles with greater precision. For investors and business owners, it necessitates a keen awareness of credit indicators and a robust risk management framework. Understanding this sensitivity can help reduce anxiety and foster more informed decision-making. Several pervasive misunderstandings cloud our collective perception of credit. One common fallacy is the belief that credit problems emerge suddenly, like a bolt from the blue. In reality, credit conditions evolve gradually, with subtle shifts in lending appetite, risk assessment, and borrower behavior accumulating over time before manifesting as a significant trend. These slow-moving changes are often missed until their impact becomes undeniable. Another widespread misconception is that only borrowers are affected by credit cycles. This couldn't be further from the truth. Credit conditions exert a profound influence on virtually every aspect of the economy. They impact employment levels as businesses expand or contract based on access to capital. They drive investment decisions, influencing asset prices across stocks, bonds, and real estate. Furthermore, credit conditions significantly shape overall economic confidence, affecting consumer spending and business sentiment. Even individuals with no personal debt are indirectly affected through their jobs, investments, and the general economic environment. Recognizing these broad ripple effects is key to a holistic understanding of our financial world. Credit, at its core, is a tool, a powerful instrument that can be wielded for immense benefit or significant detriment. Used prudently and strategically, it serves as a catalyst for growth, innovation, and stability. It enables productive investments, facilitates wealth creation, and smooths economic fluctuations. However, when used excessively or imprudently, credit can sow the seeds of fragility, leading to unsustainable debt burdens, asset bubbles, and ultimately, financial crises. History is replete with examples of these recurring cycles, periods of exuberant credit expansion followed by inevitable tightening and painful adjustment. These cycles are not random. They are deeply intertwined with human behavior, our optimism during booms and our fear during busts. Understanding this cyclical nature provides invaluable perspective, allowing us to view economic fluctuations not as unpredictable anomalies, but as inherent features of a credit-driven system. This perspective empowers individuals, businesses, and policymakers to navigate these cycles with greater foresight and resilience. You don't need to become a financial oracle to predict the exact timing of credit cycles. However, cultivating a deep understanding of credit offers profound advantages. This knowledge illuminates why economies sometimes slow down without an immediately obvious cause, revealing the underlying shifts in credit availability and cost. It explains why financial markets often react sharply to seemingly minor news, as they anticipate future credit conditions. It clarifies why financial conditions can shift with surprising speed, impacting everything from interest rates to investment opportunities. This clarity replaces confusion, transforming what might otherwise feel like chaotic market movements into understandable economic dynamics. For personal finance, it means making more informed decisions about borrowing, saving, and investing. For business owners, it translates into more robust strategic planning and risk management. For investors, it provides a critical lens through which to assess market valuations and identify potential opportunities or risks. Ultimately, credit literacy is a cornerstone of financial intelligence, enabling better decisions across all facets of economic life. This episode has laid the foundational understanding of credit, its creation, its role as an economic engine, and its cyclical nature. We've seen how credit expands purchasing power and amplifies both growth and slowdowns. In our next episode, we will delve into an equally critical, yet often more elusive, concept: liquidity. Liquidity is the invisible force that determines whether credit can function effectively at all. It explains why financial systems can sometimes freeze, even when underlying assets still exist, leading to sudden and severe economic disruptions. Understanding liquidity completes the picture, providing a comprehensive framework for interpreting the intricate workings of our financial world. You now understand that credit is far more than simple borrowing. It is the fundamental system that creates purchasing power, drives economic activity, and amplifies both growth and slowdown. With this enhanced understanding, financial changes are easier to interpret, less emotionally charged, and more actionable. Please like this video if you have enjoyed it or received any benefit from it. Every one of your likes truly encourages us to continue creating helpful content. Thank you for watching and have a blessed day.